Hello, everyone. This is Chris Kopak, Assistant Vice President of Facilities at the University of Arizona, also the Media Past President of APA. Today, we're broadcasting live from our Rocky Mountain Association annual regional conference in Denver, Colorado. It's a combination of the Rocky Mountain along with our local state chapter, Colorado APA. We got a great topic, great timing for this coming into the winter months. The changing status of natural gas, and Ben Strauss, Price Risk Manager for Kinect Energy Group, will be presenting. As always, if you have any questions, feel free to go ahead and type those in, send them to us. The PowerPoint will be live on the APA webpage along with the audio. Usually that takes about a week. With that said, if you do have questions, send them on in. And also, you're eligible for CEUs. And you can use those as you look at extending your CEF or EF credentialing. And so that's critical also. So without any further ado, Ben, we appreciate you very much, and Kinect taking time to go ahead and educate our listeners. Go ahead and take it away, the changing status of natural gas.
All right. Well, thank you, Chris. My name is Ben Strauss, and I am indeed a price risk manager at Kinect Energy. And maybe to start out, before we dive into the subject of the discussion today, give you kind of a little bit of a user's manual for what we're about to go through. The idea is that Kinect works with a number of universities and schools across the U.S. to help them manage their various elements that touch on energy and their consumption of energy, the price of energy, et cetera. And one of those dimensions that we work with our customers on is keeping an eye on the market for commodities, in this case, natural gas, and helping them to make some wise decisions when it comes to how they approach those budgeted costs. So specifically, we want to know what's going on in a given commodity market to help our customers decide whether or not it's the right time to fix or determine the price of their input and how far out and how much. And so, a critical element of that process is knowing what's going on in the market. And then a second element that's perhaps a bit more specific to each individual customer of ours is, what's your particular situation? And so you're getting one element of kind of the overall service here in terms of seeing what's going on in the natural gas market. But to really kind of get the full effect, I think it helps to have some time with an expert talking about what your particular needs are. So that's kind of how we use the data you're about to see and sort of understand the limitations of what we're putting forth as well, because what we're talking about is pretty general in terms of our view of the market. It's not tailored to an individual case. So that said, let's dig in. And I want to start out just sort of talking about some general observations about what's going on in the natural gas market and why it matters. So to start out, I think I talked to this group about a year ago, and I had observed at that point in time that we had not seen a ton of production growth in the natural gas market as of around September of last year. A year, fast forwarded, and we see that as very much different. Production has grown pretty substantially over the course of the last year, and that growth is actually accelerating over the course of the last few months, which from a consumer's perspective is a pretty encouraging thing, because growing supply, growing production of natural gas should be, if nothing else changes, it should be a pretty bearish event, or should be pushing prices lower. However, that's not the only moving piece in the natural gas market. Over the course of the same 1-year period or so, we're seeing demand growing to new all-time highs, especially in certain segments of the natural gas market, which creates a little bit of confusion in terms of a price signal. And amidst all of this, we're seeing natural gas inventories, which are pretty critical during the winter period, at, I would say, somewhat anemic levels. And then finally, our winter weather forecast, granted the forecast in the weather is definitely an imprecise at best science, especially a long ways out. But the best data we have, the best indications from meteorologists we can see, point to perhaps a greater risk of cold weather than we've seen over the course of the last 2 years for certain. And so all these things together have had an impact on what's going on with natural gas prices. So if you look here, what you can see is that natural gas prices have been in what I would say for the short term, have been in a relative period of stability. We have not seen a NYMEX settlement that's been above $3 or below $2.50, essentially over the course of the last 10 months, for much of this calendar year. However, if you look to the far right-hand side of the chart, you should notice some little green bars that are creeping up past $3. And actually today is the day that they settled, the last kind of pricing value for the NYMEX contract for October. And that did, in fact, settle above $3. So we have the first natural gas settlement for the commodity, the market that's traded electronically and financially, that references a particular delivery point in Louisiana, trading above $3 for the first time in essentially 9 months. So we're seeing some changes in the dynamics of pricing, and it sort of gets back to this idea that despite production growth, we have demand growth and inventories at levels that are slightly concerning to market participants. So it's kind of a conundrum as far as how to approach things in the short term, and it's worth examining some of that data a little bit further. The other thing I'd call out before we move into kind of those specific drivers of what's going on with prices is if you cast your eyes to the left-hand side of the price chart, you can see where that NYMEX value was for a single month in the middle of the last winter we had. And you can see that big green bar up around $3.60. So in the last 12 years, we've had NYMEX prices as high as $3.60, which is a far cry from sort of the just north of $3 we're seeing today. And if we think back a couple of winters, we've actually seen prices as high as $4 in the short term. So, the reason why this is, I think, relevant to a lot of folks who are consumers of natural gas and have that as a budget line item is that there's some volatility that's built into the winter pricing of natural gas, especially, and in the next 5 months or so, we're perhaps a little bit more exposed to that given the overall set of market conditions. So, what do I mean by that set of conditions? Let's start with the good from a consumer's perspective. What you see here is domestic production of natural gas looking back about 6 years. And a year ago when I talked to folks at APA, one of the things I was calling out is that we haven't really seen a ton of production growth. In 2017, we were sort of stuck in neutral. It sort of felt like we had not seen a ton of growth since basically 2 years prior when we had hit our previous all-time high, and we were seeing some encouraging signs that have now borne fruit. The natural gas market is growing overall, and production is leading the way, especially in the last few months, up about 6.1 BCF per day on a year-to-date basis versus the prior year, which is the largest, on a percentage basis, growth rate we've seen in the last 8 years. So the good news for consumers is production is really growing and growing well, but that sits at odds with what we're seeing in recent price dynamics. So if we look a little deeper, I think we can point to some of the reasons why the market is discounting what's going on with production, at least here in the short term. And if what I'm showing now is a more granular view of production, and it's over the course of the last 3 years to kind of keep the chart from getting too noisy. So you can see in 2016, the blue lines, we had slightly declining natural gas production. That coincided with a bit of a rise in prices. And for much of last year, the red lines, you can see basically through September, slight growth, but not a lot, especially compared to where we were in 2016. It really wasn't until September of last year that production started to kind of take off. And a number of things aided and abetted that. One of the key pieces was growth in pipeline infrastructure that allowed constrained natural gas producers to finally get their gas to markets. And during the winter period of 2017, we saw that bump in production through December, and then things sort of stalled a little bit in the first half of this year before again sort of taking off right around June of this year. That's the acceleration that I've been talking about. So in aggregate, production looks really good, but it's worth noting that we've really only seen this big run up from around 78 BCF per day or below to well north of 82, touching as high as 84 BCF per day very recently. That's only been over the course of the last 3 months. So I guess I want to call out the time, like the slide says at the top, the timing of our production growth matters. We've had a substantial amount of production growth, and it looks really good on a year-over-year basis right now. But if you look back into the earlier part of the year, it's not quite as strong, and not that strong versus even 2 years ago in 2016. So production is growing, but it's sort of with that caveat of it's only ramped up recently. And we want to set that against the backdrop of what's going on the demand side of the ledger. So I've got all the different segments of demand laid out here, and we don't need to try to process this whole thing in too much depth right away. We'll go into each kind of the individual pieces. But the thing I want to observe to folks is if you just look at the stack of the bars overall, while production has been growing, demand has been growing as well, and it's been growing by just about as much, if not a little bit more than production has over the course of this year so far. We're saying we were up nearly right around 10% on our domestic production this year. We're up almost exactly that same amount on demand, and it's across basically all segments. Each of the kind of the big three that we look at when we're talking about natural gas demand: industrial demand, power generation, and rescom. Those are in blue. Residential and commercial demand, I should say. Blue, gray, and red there. They all have their sort of individual flavors of seasonality that are worth talking about. Industrial demand is by far the most stable. Power generation demand is a little bit more relevant in the summer because natural gas is used in part for to support air conditioning load. And so when it gets really warm in the summer, gas is burned for that power generation that goes to support our cooling needs. And so it's got a bit more of a peak at that point in time. And then in the summer period, which we're looking at here, April through October, residential commercial demand, space heating, water heating for food, et cetera, is a little bit less relevant. Once we get to the winter, it becomes a pretty big deal. So we'll return to that in a second. And the last two pieces I want to just sort of call out just to kind of identify what we're looking at across the demand spectrum are exports, either via pipeline to Mexico, or in the green at the very top there, you probably read about at least a little bit in the press, liquefied natural gas exports that go pretty much anywhere in the globe. So the big picture story is that we are seeing demand growing, and I think it's worth saying at this point, demand has been growing kind of faster, at least in the start of the year, than the supply production growth was happening. And that's why we find ourselves in the situation that we're in as we head into winter. So what I'm showing you here gives you just a quick kind of look at one of the other major drivers for demand for natural gas, which is the weather. And I want to call out specifically here what you see sort of the right-hand side of your chart. To give you an idea of what you're looking at, the black dotted line represents the normal over the last 30 years, what we call total degree days, or the deviations from a 65-degree normal in terms of temperature, and it's weighted for the population in a given location. So each of those bars represents 1 week's worth of deviations from that 65-degree normal, weighted by our domestic population. And the reason I want to call your attention to the right-hand side of the chart is you can see during the summer, say from mid-June through September, right where we are now, we have what I would say is a pretty robust demand profile. Each of those individual bars is poking up above the black dotted line, which represents kind of normal, except for 1 week in July. And what that means is that over the course of the summer, we've essentially had stronger demand than you would typically expect over the last 30 years. So I'm bringing this up to highlight what we're going to see here, which is power generation demand, one of the kind of the key movers as to why demand is up and remains elevated for the natural gas market. Part of that increase versus prior year levels and pushing us to all-time high levels is a function of a slightly warmer than normal summer. But if you looked at those bars on the previous slide, if you look at them again here, you can see that aside from a few weeks where it exceeds that normal level, the dotted line, by a large amount, it's been nothing like a barn burner of a summer. And so just the weather by itself doesn't explain why we see record high levels of demand for natural gas to support power generation. And I would suggest that there's a couple other factors going on that are relevant to someone who's thinking about their gas purchases in the long term. What we've seen over the course of the last 4 years has been a move in the utility space away from coal and towards natural gas as a source of power. And the reasons for that move are varied. In some regions, it's retirement of old coal-fired power plants that are not particularly efficient, perhaps not even price competitive, and definitely a bit of regulatory uncertainty related to things like the Cross States Air Pollution Rule or the Mercury Air Toxins Act that caused utilities to make some decisions about investments, 5, 6, 7, 8 years ago that are now kind of coming home to roost today in terms of more natural gas-fired power generation and a switch away from coal. So that's one thing that's going on, is at sort of a structural level that's driving higher power generation demand. And Kinect's view is that heading forward, those trends still remain in effect. Natural gas is still at a very competitive price level versus coal. So on a price basis, we expect to see natural gas continue to be a big piece of the power generation market. And we also see those decisions made by utilities continuing to play out in terms of a shift in the mix of their production for power toward natural gas and away from coal. The last thing that's probably relevant in that sense is that natural gas is also a pretty good fit for utilities that are diversifying their portfolio production towards renewables, in the sense that the sun doesn't always shine, every day, all day long, and the wind doesn't always blow, and battery technology is pretty expensive. So when you don't have those intermittent renewable resources available to you, it's pretty easy, as from a utility's perspective, to fire up a natural gas turbine to produce the power you need to serve your requirements. So those are all factors as to why natural gas has been at higher levels than if you look back to the 2016 curve, where we set, at that point in time, the record highs for consumption for power generation demand on the back of what were at that point in time the lowest real dollar costs of natural gas we had seen ever for the industry. So prices are a far cry from where they were in 2016, and yet we're consuming more than when we had really, really cheap energy available to produce power. And I think that's a meaningful sort of sign for the market that this is a trend that will continue heading forward. So production's up, but we're also seeing demand for power generation up. We're also seeing export demand growing. So what you see here are, in BCF per day again, exports to Mexico over the course of the last 6 years. And it's been a pretty consistent trend from about 2013 forward, where we see more and more gas headed south of the border to Mexico. And there are some pretty good reasons for this. First and foremost is we've seen a build out in pipeline capacity to provide more supply to head to Mexico. And what I'm showing you here, just to give you an idea of kind of where the prices are at various locations, and the injection points where U.S. gas kind of crosses over the border to go into the two main distribution pipeline systems that we have in Mexico. And if you look carefully at what the map shows, you can see little purple dots that to me, they don't look particularly representative, but those are new or expansion gas-fired power plants. And historically, Mexico has required, has really relied on, I should say, oil or petroleum products to burn for power generation across much of the country. And they are far less efficient cost-wise or environmentally than natural gas. And so over the course of the last 4 years has been a really concerted effort to try to transition away from petroleum-fired power generation towards natural gas. And on top of that, in industrial applications, natural gas has been pretty efficient compared to, say, propane or other alternatives for their heating requirements. So just for a variety of reasons, it's made sense for Mexico to make a push towards expanding their natural gas infrastructure, and cheap supply in the U.S. has helped facilitate that. So the last piece of the puzzle for why more gas is heading to Mexico is what you can see here. Mexico has focused a lot of its resources when it comes to their national petroleum or national oil company on producing oil rather than focusing on natural gas. So over the course of the last 5 years, you can see that Mexican production of natural gas has tailed off pretty substantially, probably to the tune of about 2 to 2.5 billion cubic feet per day, where at the same time they have sort of substituted domestic production for imports from the U.S. And so that trend we expect to continue. With the limited capital that they have down there, they will continue to kind of focus on the higher rate of return drilling assets, which are oil related, and will be less and less focused on natural gas. So another reason why demand is rising and has risen perhaps a little bit ahead of what's going on with domestic production of natural gas here in the U.S. is an ongoing expansion of exports to Mexico. So that's the situation with Mexican exports, and then on top of that, we have another sort of source of export demand, which is liquefied natural gas. And over the course of the last 3 years, we've seen a total of 2 facilities that export natural gas that have been built here in the U.S., and they currently export about 3 to 3.5 billion cubic feet per day, and that trend also appears to be pretty stable and growing on a forward-looking basis. So just across pretty much every segment of the market, I didn't show you industrial demand growth, which is also a piece of it, but it's kind of, I wouldn't say it's boring, but it's less of a significant impact on the market, especially on a forward-looking basis. Between industrial demand growth, power generation demand growth, pipeline exports, and liquefied natural gas, we have all these different segments coming on, with decent growth, especially towards the start of the year. And so although production growth has been up, it's been offset by stronger demand. So let's bring it all together. Just a quick look at the kind of the supply-demand balance. I apologize. You can see our overall growth has been pretty good in terms of production. The blue bars to our left, both in terms of a kind of a month-to-date basis and also on the year-to-date basis. But at the same time, we've seen all these different segments of demand really shoot up, and you can see how strong and how important power generation demand has been at the base of that stack there. So that's kind of what's going on between supply and demand, and it kind of plays out in terms of what's going on in our storage inventories. So what you see now in front of you is the 5-year range of U.S. storage inventories in that gray sort of space to your upper left. 2017 is represented by that red line, and 2018 is where we stand today. And it's pretty clear we're outside of that gray 5-year range. We're below the minimum we've had over the course of the last 5 years. And this kind of brings home the notion that even though production is growing at a pretty rapid rate compared to the prior year, the timing of that production growth has not been sufficient to allow our storage inventories to remain on a normal trajectory. And that's pretty important because we need storage as an asset for just the United States as a whole to offset the spikes that we have in demand that come over the course of the winter, which generally speaking takes our overall demand profile above the relatively more stable supply profile. So what I mean by that is you can see the seasonality to natural gas inventories. If you look at that dotted line or the red line or even the blue line, we tend to produce more natural gas in the U.S. than we consume in the months from about April through about October or early November. And from November through March or into April, depending on the year, we tend to consume more than we produce. So if we're not going to be starting out the winter period when we'll start to draw down our inventories with an amount of gas in inventory that is comfortable or strong enough relative to what we could draw it down by, the market starts to get nervous about whether we'll have enough supply to meet demand or cover demand, and it can cause prices to get a bit more volatile and maybe even push upwards a little bit. And if we kind of forecast out where we expect to be by the end of the injection season, by the end of October, our expectation is that we don't get back to kind of that normal level of coverage that we've seen over the course of the last 5 years. Our best case scenario is probably about 3.5 trillion cubic feet or 3,500 BCF by the end of the injection season, which still puts us about 350 short of the 5-year average level depicted in that light gray line there. So again, we're outside the 5-year range. Is that, how significant is that? Well, if we end up at the forecast level of around 3.4 or 3.3 TCF, we have seen winters in which we've drawn down more than 2,800 billion cubic feet, 2.8 TCF, which would put us at record low inventory levels coming out of the withdrawal season. And that's only on a backward-looking basis. If you think about where we just talked about as far as the demand profile changes we've seen over the course of the last year, we have essentially a structurally higher base of demand. And so if we add on top of that weather-sensitive demand for home heating, for commercial heating, et cetera, we could see an even stronger pull down of our inventories this winter. It's not by any means, a guarantee that's going to happen, but that's the risk that the market is looking at and starting to kind of price in, starting from a lower base, dealing with a structurally higher level of consumption, and it has to price in or kind of contend with the risk of a cold winter period that would further exacerbate the strength of demand. So let's talk a little bit about what that winter forecast looks like. What you see in front of you is the current forecast from Weather Services International, which is a private forecaster owned by IBM, that they're looking at sort of the next 3 months as far as the overall temperature forecast, and looking at a difference from normal is what the color scale represents. So overall, this is a pretty encouraging looking picture. It's warmer to the northwest, and that white line that you see running from sort of Texas up through Oklahoma and then back down to the Gulf Coast is sort of the demarcation between leaning warmer than normal and leaning colder than normal. So the 3-month outlook is pretty encouraging, and it's a function of a broad climate pattern called the El Nino Southern Oscillation. Sometimes folks call it, in just a very short kind of moniker, the El Nino. This is a very typical El Nino pattern, that warmth across the Pacific Northwest, and in most El Nino winters, you tend to see that warmth extend across most of the northern tier of the U.S. So the forecast you see here is representative of what kind of the key drivers of the El Nino are pointing at. If you look at the two charts here, it probably looks like gobbledygook to begin with, but as you kind of dig into it a little bit, it starts to make a little more sense. I'll start with pointing out what's on the right-hand side of the slide. What you see here is a realized and then a forecast sea surface temperature value in centigrade above or below normal for a certain portion of the Pacific Ocean right along the equator. And the warmer that water gets, the more likely you are to have an El Nino event. So the black dotted line you see to the right-hand side of that chart is pointing to just under 1 degree centigrade above normal, definitely above a half a degree centigrade above normal, and that in turn correlates to what you see on the left, which are those red bars in a probability percentage graph, rising above 60% likelihood for the El Nino happening over what I would call the key core months of winter, December, January, and February. Almost 70% chance. So, the sea surface temperatures are one of the main drivers of the El Nino Southern Oscillation, and when we do have an El Nino event, we tend to see a warmer than normal northern tier of the U.S., where you do have a lot of population centers, especially in the East Coast and the upper Midwest, and you have a lot of demand for natural gas for home heating. So on the face of it, this looks pretty encouraging. However, we've only looked at the first kind of 3 months of winter on the forecast, and as we look at kind of the balance of the winter, there are some concerns that arise. So what I'm showing you now are individual monthly forecasts through January, and you can see sort of a change in the pattern. The El Nino is not going to be a particularly strong one based on what the sea surface temperatures are showing right now and what they're forecast to be. And as such, we're perhaps less likely to have that nice warm northern tier that you see depicted, for example, on the December chart. We're looking at or concerned about, as we head into January and the start of next year, a sort of change in that pattern in cold air as a whole, kind of leaking into the Great Lakes, the Northeast, the Mid-Atlantic, where you have all these large population centers that require a significant amount of natural gas when they are heating their businesses or their homes or their universities or their hospitals. And so the overall kind of look at the winter is one that might start out fairly warm, but has a decent amount of risk to turn colder towards the second half of the year. And if you look down to the very bottom of the chart, I apologize, you can see that the December, January, February period for gas-weighted heating degree days is currently forecast around 2,608. That's the same sort of view we were taking towards the beginning of the presentation, where we looked at the differences from that 65-degree normal. That's what those heating degree days are. And you can see that that compares pretty, from a price perspective for natural gas, pretty bullishly versus last year. And it also looks like it's stronger than we have in the long-term 30-year normal, that 1981 to 2010 mean. The other thing that I would call out in talking about kind of the winter weather forecast, besides the fact that it's a long-term forecast and therefore by its nature pretty uncertain, I would say is that that 81 to 2010 mean is composed of a larger number of observations that are cooler in the 80 to 2000 range, meaning the last 10 years have been relatively warm compared to that overall sort of longer-term 30-year average. So even though a 2608 forecast for heating degree days looks normal-ish, in the longer-term perspective, over the course of the last 10 years, that's a far more kind of a cold-leaning winter than what we've seen typically for the 2000s, so or the 20 teens. So the concern is that between a stronger demand profile structurally than we've seen in the past, and a weak inventory scenario, we may not have enough domestic production growth here over the course of the next 4 or 5 months to support prices that remain at the levels they've been for pretty stable throughout this year. And so that's what we're seeing here when we look at the price for natural gas from the November through March period, or the winter strip that we're looking at. We went from a period of seasonal weakness in early September, where prices were down as low as $2.85 for that winter strip period, and now they've rallied back up to pretty close to the highest level they've been since July, and very close to, frankly, the highest levels they've been all year. So the winter remains kind of a concern and a risk for the natural gas market as a function of stronger structural demand and weak inventories. And the only kind of potential savior for this market would be a failure of that weather forecast to come through on the colder side, or production growth that continues to trend stronger and kind of keeps inventory concerns in check. So that's kind of the short-term picture of what's going on with natural gas. And I'm just going to give you a couple quick thoughts about what's going on in the longer term before we wrap up and take some time for questions and anything that you want to cover in any more depth. So I want to start out by just pointing out where the U.S. sits versus the rest of the world in terms of our pricing. So even though the outlook for pricing that I have right now is at least a little bit risky to the upside, it's nowhere near as bad as what you see if you were to buy gas in Japan or in Germany or in Brazil, where prices per MMBTU are hovering right around $10. In fact, the only place on the globe where you can buy gas much cheaper than here in the U.S. is in the western part of Canada, where there is literally nobody there to consume it, where you see a 99-cent per MMBTU price. So all this to really say that there is incentive for natural gas to be exported from the U.S. To Mexico, to Europe, to South America, and to East Asia. And that's what's driving what we see over the course of the next 2 to 3 years, and likely beyond that, a large growth in liquefied natural gas exports, especially a big jump coming up over the course of the next year. So right now, I think I mentioned that we export between 3 and 3.5 BCF per day of natural gas coming from 2 main facilities, one down on the Gulf Coast called Sabine Pass, and one one heading off of the Mid-Atlantic called Cove Point. And over the course of the next 12 months or so, we expect to see at least 4 new facilities come online with exports coming mainly out of the Gulf, and that will essentially double, maybe a little bit more than double, our existing LNG export capacity. We're looking at right around 7 to 8 BCF per day by October of 2019. I think it's worth pointing out that these are long-term projects. They're pretty big and intense and complex engineering projects, so there's some uncertainty as to whether or not they come on time, but it does represent a pretty big jump in demand compared to where we are sitting right now, in the market, and that is a concern, or at least a potential bullish driver of prices over the course of the next year. To make the waters a little bit more muddy, if you look at who we send our LNG to, the third largest kind of counterparty on the list is China, and last I heard, we're having some trade issues with our Chinese counterparts, and natural gas is being kind of drawn into the debate. So amongst the sort of third round of tariffs discussions or volleys, China has put a 10% tariff on U.S.-based liquefied natural gas, which essentially prices them out of the market for us. In the short term, that's not that big of a deal because natural gas, whether it's in gaseous form or liquefied form, is still a commodity, and you can therefore substitutable. And so there's some logistical changes that need to happen to make sure China gets the gas that it needs, not coming from the U.S. And our cargoes can be swapped out for something that might have come from Australia or from somewhere in the Middle East. But ultimately, it's more of just a reshuffling of the deck. The concern in a longer-term sense, however, is that if China doesn't see the U.S. as a reliable LNG export producer or partner, they may decide to focus elsewhere for their growing needs. And China is making a concerted push to get away from coal and toward natural gas as a cleaner source of energy. And so to the extent that the market is looking at down the road more LNG plants in the U.S. that are going to go to support this burgeoning LNG export market, if China doesn't see us as a reliable partner, there may be less demand for U.S. LNG, and that could put a damper on pricing heading out into the future. So for natural gas for a long time had very little interaction with global trade. And now for the first time, we're having to deal with sort of the uncertainty that comes from being connected to that global market. And it does throw a certain degree of uncertainty in terms of future value of natural gas into the mix. Another thing driving some uncertainty is kind of one of the best benchmarks for future production, which is the drilling rig count. What I've got in front of you are sort of two measures. One is gas or rigs that are drilling for oil in blue, and one is rigs drilling for natural gas in gray. Typically, there's about I would say a 9-month or so lag between when a natural gas rig is put into the field, into operation, and seeing production grow as a result of that rig drilling. So we can see by this chart that it's been about since maybe September of last year, a little over 9 months ago, not too much, that natural gas drilling rig counts kind of stalled out and didn't grow too much from that sort of mid 400s level. So we have some concern that headed forward, any inventory of wells that has been drilled may start to be depleted over the course of the next 6 months. And if we don't see the natural gas drilling rig count start to tick back up again, we could see slower production growth into the future. The silver lining is that when you have an oil rig go into the field, it also will tend to find natural gas alongside the oil. It's called associated production. And so the fact that that drilling rig count has continued to grow is probably going to provide a little bit of a boost to the natural gas production market. But ultimately, in terms of risks and uncertainties heading into the future, the drilling rig count is of definite concern and bears monitoring as we move forward. So that'll take me to kind of the longer term pricing discussion. What we see right now is pretty reasonable as far as future values of natural gas headed out in over the course of the next 5 or 6 years, with inventories at low levels, elevated demand, and some uncertainty about production and the weather. It makes sense that in the near term you would see prices relatively high compared to a more rosy outlook for, say, 2019 or 2020 as far as natural gas prices, and that's exactly what the market is showing us. That pinch on inventory is pushing prices up here in the near term, and to the extent that we get back to more normal inventory levels or a more balanced market, the market is sort of relaxing towards what are historically, as you can see from the chart, very attractive levels around $2.60. And that brings us to kind of the last piece of data I want to share with folks. What you can see is that there's been a long-term trend towards a flatter forward curve. The view of natural gas prices has gotten less concerned about scarcity. What you see here, looking back to 2012, is the prices of a 12-month period of natural gas purchases, various 12-month periods of natural gas purchases, I should say. The black line is if you were to buy, the front month through the 12th month. The blue line would be the 13th through the 24th month, et cetera, all the way out to a 5-year purchase or a 5th-year purchase in purple there. And back in 2012, when we had record low prices, we had natural gas get down to about $2.50, which at the time sounded like a great deal. And 5 years out, you were going to be paying $1.75 more for your gas at $4.25. Fast forward to 2016, the second time in the last 5 years when natural gas has really cratered. You saw that front 12-month strip now down to about $2.25, and at the same point in time, buying out into the future for that 5th year out was still a pretty decent premium to that. It was right around 275-ish, so 50-cent premium. And now, if you look out into the future, you can buy that 5th year actually cheaper than what you can buy it for today. And granted, prices today for that first year are slightly more expensive, but overall, there's been a big flattening in the cost of gas into the future. And what I think is driving that is the cost of production. So what you have in front of you here is kind of a view of the long-term supply curve for natural gas. And what we see is that back in 2013 or 2014, to meet the overall expected requirements for domestic consumption. If you look at the chart to your left there, you can see that darker blue curve representing 2013 had kind of the last or the incremental or the marginal MMBTU coming from somewhere out in the Rockies, and it cost probably around $4.50. And there was a lot of uncertainty there. If you look just a little bit to the right of that vertical line, which shows 100% of expected consumption, the price point really jumps up. So if we were off a little bit on our expected demand for that year, prices really kind of ratcheted higher. But over the course of the last 5 years, that inflection point has moved farther to the right of 100% expected demand, and the curves have dropped down to closer to $3 per MMBTU for that incremental or marginal unit of supply. And that's just one view. If you look to the right, one of the Canadian analysts that we follow is pointing towards, into the future, a very reasonable, I would say flat long-term supply curve that points to a price to cover new requirements somewhere in the neighborhood of $2.75 per MMBTU, maybe a little bit higher there. And even if you have more demand, it doesn't ratchet the price up by very much, because there's so many different places that you can purchase can produce natural gas across the U.S. and even into Canada. So for a variety of reasons, we think that the flat long-term supply curve makes some sense as far as what it costs to buy gas out into the future, because the production economics are pointing in that direction. And it has some implications for how folks who consume natural gas should approach their purchasing. Yes, prices are attractive, but it pays to be kind of careful to a view of what the cost of production is, because you don't want to commit to too much too quickly at a given price just because it looks like it's going to beat your budget for this year. So there's some uncertainty in how the pricing of natural gas out into the future ought to be approached by consumers, even though we have some real concerns here for the short term, and we are seeing some pretty attractive levels in 2020, 2019, and beyond. So kind of key takeaways. Inventory is at a pretty risky level for this time of year. While domestic production continues to be encouraging, a combination of potential for a cold winter and really strong structural demand growth puts us at risk for higher prices. And I'll remind you, we showed at the very beginning, we had spikes to $2.60 and to $4 in the last 2 winters with better inventory and weaker demand, and albeit also weaker supply. So there's room for this market to run up as much as 30 or 35%, I think, given the current environment. And that's meaningful if you haven't already taken that risk off the table and have a budget you're trying to protect. In the long term, we do expect some of those demand drivers to continue. We continue to expect LNG exports, pipeline exports to Mexico, and power generation demand to be growing at pretty strong levels. And at the same time, there are some reasons why we don't expect prices to drop too far below $2.50 in the long term. Plus we have, like I said, that LNG export demand. So for a variety of reasons, it's worth looking at what you can do on the longer term basis if that makes sense for budgets. But you have to do it in a thoughtful way, given that there's a lot of different factors that are still in play and still up in the air for the longer term. So with that said, I want to leave a little time for questions. And Chris, if you're still with us, and hopefully I'm not talking to myself, please let me know what you'd like to dig into in more depth.
Well, Ben, I'll tell you, we have gotten a lot of questions, and we wanted to wait till the end. This has just been outstanding presentation. I think the biggest question that folks have coming into the winter months, and you're up in Minnesota, if I recall correctly?
That is correct.
What's happening with the amount of acorns, and how big are the squirrels this fall? And that's always an indication of what the winter weather's going to be.
I can't say the squirrels look any bigger or bushier or furrier. But I can say that a number of folks have dropped by my desk in the last 2 weeks saying that there are a lot of acorns on the ground around their properties. So to the extent that that's any kind of indicator of a cold winter, it's not a good sign.
And if folks don't understand what we're talking about, that's always the old wives' tale that if squirrels are heavy and they're gathering those acorns, we're in for a tough winter. Well, listen, we have an interesting question. We have Emmett Boyle from Canada, Regina, Canada, and he's asking a question, and maybe you can pull up the slide that showed the world view of the actual cost for natural gas.
I can do that.
And the question, as you're pulling that up, is you're able to do a 5-year forecast looking at the North America, United States. Are you able to do a 5-year forecast for Canada and also Mexico, seeing that they're also part of our APA family?
So if I understand the question correctly, what is the kind of the 5-year forecast for Canada and Mexico?
Exactly.
I would say
we look at
generally speaking. Yeah, well, Alberta is not representative of Canada as a whole, that's for sure. I would say that the same, so in terms of overall costs, Canada tends to be moderately cheaper as you kind of are in the western half of the state or of the country versus the eastern half, because there's a decent amount of requirements in terms of transportation to move what's very cheap gas from way out west to the east, or from, say, south of the Great Lakes in the U.S. To the eastern portion of Canada. So I would say that 99 cents is not going to be representative of the whole country by any means. However, I would say Canadian demand is growing a little bit, but there's also indications that the cost of supply in Canada is subject to sort of the same rules that that production is in the U.S. And so demand shouldn't be swamping supply in Canada in any way, shape, or form. So I would say pretty static overall prices in Canada. Again, subject to kind of some regional variation. And that would be the true out, I would say, at least 3 to 4 years into the future. One uncertainty when it comes to Canada, we talked about the value of liquefied natural gas, and obviously how cheap it is in Alberta and the Western Canadian Sedimentary Basin more broadly. There has been a lot of talk for a number of years about building an LNG export facility on the Pacific coast and of Canada. And the current project that has the most legs is called Kitimat, and it would take some of that Western Alberta gas and move it likely to Asian markets. And so there are some uncertainties as well when it comes to Canada's overall kind of supply and demand dynamics. But generally speaking, I would say they face kind of the same scenario we do here in the U.S. Pretty ample supply overall, and slight demand growth, just sort of naturally as a function of industrial demand, power generation to a certain degree, and then potentially LNG as well. When it comes to Mexico, I think the trend is going to be towards cheaper supply, relatively cheaper. And the reason I say that is, if we recall kind of if I can find it here, the drilling rig count for oil, that blue line that I'm showing here, a lot of that growth in the drilling rig count is happening in West Texas. And there's not a ton of capacity for natural gas to sort of get out of that region. The Henry Hub benchmark for natural gas is on the Gulf Coast in Louisiana, and almost all of the pipeline capacity for natural gas that would move gas from West Texas, where more is being produced, to the Gulf Coast is all used up. And so the price of natural gas in that region has consequently fallen pretty dramatically. You can buy gas in West Texas for $1.40 under NYMEX here in the next month or the next couple of months. And that's going to help out with Mexico, which is facing much higher domestic costs of production. And you can see that they've started importing more gas from the U.S. over the course of the last 4 years, and that has helped to offset relatively high gas prices there. So I think that while the U.S. and Canada should remain pretty stable in terms of their gas prices, aside from short-term shocks like the weather or an inventory situation that's tight, like we're seeing right now in the U.S., Mexico should have a structural move towards lower prices as imports continue to kind of offset the relatively higher costs of other hydrocarbons they've been using for various purposes.
Well, I'll tell you, we got a lot of questions here. We'll try to get through a few more. And again, if we don't get through them all, we will go ahead and post them onto the APA webpage here in about a week. Ian has asked a really good question. It goes to the tariffs. You had a slide in here that was showing how much natural gas was being shipped throughout the world in the United States. China was listed as the third largest in importing our natural gas. And with the tariffs going on now, what do we anticipate where that makeup is going to come from in terms of the United States not being able to go ahead and ship that natural gas out to China? Will they get it from Russia? I believe there's a pipeline that is finishing up from Turkey to Russia now, or where will they make up that difference?
So China has a couple of different alternatives for where they could source their gas if they were going to avoid the U.S. There are a number of Australian projects that are slated to come online between now and the end of the decade. They've also recently completed a relatively large, I think it's about 1 BCF per day, pipeline coming from Russia that will supply them with natural gas. And they're already in discussions with Russia on the idea of perhaps a second pipeline of equivalent volume. So there are more producers of natural gas in the world than just the U.S. And while we are definitely a low-cost supplier compared to other nations, they have some alternatives. And like I said, to the extent that the LNG market it's a commodity market. If China's not taking U.S.-sourced LNG, perhaps that means that they'll take something that might have been destined for South Korea or Japan or India, and that will offset demand, will be offset by supply going to South Korea or Japan or India rather than a U.S. cargo heading to China. So there's like I said, some shuffling of the deck that can occur when it comes to the overall global LNG market, because LNG is a commodity like soybeans or hogs or lumber, but it just changes kind of the logistical components of it.
There's a question that's come up. We have from Ted Ladner, and it talks about the power generation in the push to go net zero in terms of emission, whether it's 20, 30, 40, or 50. You did mention that the production of natural gas is increasing as more and more folks are coming off of coal. But how is there going to be an effect looking over the next several decades as universities, colleges are looking at their turbine production and possibly putting those turbines to rest as they're trying to go net zero emissions on campus?
Yeah, that's a fascinating question, and I think you're spot on to say that natural gas is perhaps cleaner than coal, but it is also a hydrocarbon and therefore is associated with carbon emissions when you combust it. The challenge I think that we face heading towards that sort of zero emissions world is whether or not battery technology gets good enough and cheap enough to essentially move hydrocarbons out of the stack. We don't see in the course of the last 30 or 40 years any real growth in nuclear power generation. So storage in that sense, having a fuel, nuclear fuel you can combust, is not really an alternative. We're kind of looking at this point, it looks like wind and solar as kind of the key renewables that can be expanded as far as production. We're running out of the ability to really put any more dams in to do hydro as a source of power. So how do you deal with the intermittency of those resources? It could be pretty expensive to build a lot of potentially redundant transmission lines to make sure that you have enough various sources of power that you can find some place where the wind's blowing or some place where the sun's shining. And if that's the case, if you can't if the sun is not shining or the wind's not blowing, you need to have some sort of store of power somewhere to offset that in your sort of zero emissions world, and that points us right back to battery technology. And right now, batteries are relatively expensive, both to install and in terms of kind of their operational requirements. And so, the expectation is that we'll see growth in gas demand, at least over the course of the next couple of decades, to be sort of the pair with expansion of renewables, because gas is a really good fit in terms of being able to deal with a sudden change in the wind forecast or a cloudy day. Gas can fire up or drop down depending on renewable production far more rapidly than a coal-fired power plant can, and definitely more than a nuclear power plant can. So it's a nice natural fit, but in the long term, I think if there is a strong drive towards zero carbon, it'll be the degree to which battery technology becomes more economic that determines how long natural gas sticks around. But right now, we don't see that happening for at least a couple of decades. And frankly, in terms of hedging the commodities, it's too far out to make any real strong decisions on that front.
Well, Ben, we're just running out of time, but a quick question. You did mention the exports to Mexico continues going up, and I believe they're going to be doubling in 2019. What will that do to the demand? It's a classic demand question about price increase. Is that going to be driving the price up now, especially if there's a shortage in productions?
If there's a shortage, if we see production flatten out, especially into sort of the first or second quarter of 2019, I think that expansion of pipelines to Mexico will definitely have an impact on domestic pricing and could keep things elevated throughout 2019. All else being equal, if we have kind of a normal winter scenario, and we don't have any surprises on the LNG front, if we don't run into more tariffs that sort of shut in that demand, yes, I think that we would have a pretty decent amount of support for natural gas prices. But the one thing that I will point out, if you think about that production that's happening in West Texas and to a certain degree in the Rockies more broadly, there's limited pipeline capacity to move that natural gas to economic markets. It's the reason why you see prices in the Permian and West Texas at $1.40 below the Henry Hub price. And so to the extent that they have more capacity available to move the gas south of the border, the limiting factor isn't really, I don't think at this point, supply in Texas. There's not enough connective capacity within Mexico to get the molecule to the power producer or to the industrial facility that wants it to offset propane. And so I think what you'd see is perhaps a muted effect on kind of the benchmark NYMEX price, but I think you'd see a stronger impact on the regional pricing in western Texas. I think some of that gas would be able to flow more freely and therefore wouldn't be at such a steep discount to the NYMEX benchmark. So I think it's a kind of a question of that old real estate thing: location. Where are you, and where's the gas coming from? Because I'm sure there's some producers in Texas right now who just can't afford to operate their wells. They'll leave them sort of plugged up because they're just not able to get that gas out to a market where they can be profitable. But if there's more available capacity going down to Mexico, that might change to a certain degree.
Well, thank you very much, Ben. And we've run out of time. There's several other questions. And again, we'll go ahead and put the questions online. Ben, any final thoughts before we wrap it up?
I just want to remind folks that we're heading into sort of an uncertain period of the natural gas market, and prices tend to get a little more volatile, especially heading into the last quarter of the year. To the extent that folks haven't done anything to secure their budgets for this winter, I think that's a really encouraging. It's something I'd really encourage them to take a look at. And like I said at the very beginning, the market data is really important to have, but also an understanding of how each individual consumer approaches the market is sort of the other key piece to making the best possible decisions. So anything you can do with whoever works with you on that front to make sure you're taking the market data and applying it appropriately for your situation is really important as well. So those are the things I want to leave folks with.
Well, Ben, thank you again. We're going to make this an annual webinar right around this time, going into the winter months, right around September, October. Our next webinar is going to be off cycle just a little bit. We're scheduling that for November 8th. That's going to be looking at our steam distribution systems. And so we have an excellent speaker on that, Leeson, who has also spoke at IDEA and also APA. We're also going to be discussing a little bit about our APA member survey, giving some updates on that, on the recent survey that was completed. So I want to thank Renee Coda for helping coordinate stuff behind the scenes. And Ben, thank you very, very much for taking time to enlighten our members. We appreciate your service and Kinect Energy Group on the changing status of natural gas. Thanks for everybody for joining. We appreciate it. Thank you.